If your wealth is completely in tandem with the economy, then you do not have your portfolio dialed in for the appropriate upside that you may be looking for in the future. For instance, if the economy is doing poor and your wealth seems to be doing the same alongside the economy, then you are clearly not diversified appropriately. And on the other hand, if the economy is doing extremely well and your wealth is doing extremely well alongside of it, then again, you are still not having your portfolio diversified enough to reap the most upside potential for your future. And in this video, I want to go over the exact reasons as to why it is extremely important to have uncorrelated assets in your portfolio. Without further ado, let's get straight to it. Welcome. If you're new to the channel, my name is Matt Jimenez. I'm an entrepreneur who has worked with the greatest minds in finance over the last several years, and I'm here to pour into you guys everything that they pour into me. And in this video, I really want to weigh in on the importance of finding an asset or a vehicle that is uncorrelated to the economy. And even for you day traders, it is extremely important to understand the importance of non-correlated and correlated assets, because while you're in and out of these trades, if you have contradicting trades, meaning they may be completely correlated, then chances are you may be burning yourself in the long run, which is why you've maybe never turned a profit manually trading. But first, let's stick to the importance of uncorrelated assets. First and foremost, if you don't understand what an uncorrelated asset is, to put simply, it is an investment that is not correlated, meaning it does not move in tandem with the performance of the overall broader markets like the economy. So if the economy is in a recession or in a bull market, your portfolio or this asset per se does not reflect the performance of that particular market. Meaning if we're in a recession, you could still be earning the same amount of gains in your portfolio as you would during a bull market. And this is extremely important to have because, as we know, economic uncertainties are 100% prevalent in our history and in our future and in our current days. So if you do not have something that can offset these unpredictable situations as we often find ourselves in, then you may be subject to the long drawn out recessions that can take up to a decade just to recoup the gains, and also having to time the market in a bull market just to capitalize on what your potential wealth could be. Diversifying your portfolio is actually mitigating how much risk and exposure you have to things, which oftentimes will lead to you having far more upside in the long run because, again, you are not subject to volatile swings. So the more diverse that your portfolio is, the less volatile it actually becomes. For instance, let's say your portfolio is heavily in equities. Well, we all know that equities are pretty much in tandem with how well the economy is doing. So when you have a portfolio that's heavy in equities, well, now you're subject to all the volatile market conditions of our economy, whether it's change of interest rates, quantitative easing, quantitative tightening. All these things are things you cannot control. But if you're in equities or in traditional markets, you are probably subject to all of the ramifications of those things happening in our economy. Surprisingly, having uncorrelated assets actually helps with stability. Let's say that you have a pie chart as your portfolio and you have a small piece of it towards equities and the other goes to something that's completely non-correlated with equities. Well, now when the equities are performing poorly, instead of your portfolio getting dragged down alongside the performance of equities, now you have the uncorrelated asset that's performing against, that is offsetting the performance of the equities, meaning your portfolio will continue to rise instead of getting dragged down with the performance of equities. That is the whole purpose of having uncorrelated assets. It's so you have protection against super volatile times, but also have the stability of those volatile times. And the best part is during all of this, you're still performing because the uncorrelated assets typically don't ever get affected by the performance of these broader markets. Now, I'd like to actually list a few of uncorrelated assets that you could potentially look at to help diversify your portfolio and keep you safe for long-term gains and the black swan events where everything just crashes. Hopefully, you have something in your portfolio that is bulletproof against that and you can still perform. So, like I said in the beginning of this video, if your wealth is subject to when you can get your money out of a market, then you are shackled to the performance of an economy. So when things are going good, if you have to time the market, chances are you'll never time it and you will never reap the most reward for your time invested in the markets because you're trying to time something that can't be timed. And then on the flip side of that, if your wealth is tied to a recession, well, guess what? Oftentimes, a lot of the recessions that have happened, like in the year 2000, that took a whole decade to recover back to its heights, well, guess what? Now your wealth is locked up for however long it takes to recover. Oftentimes, like I said, it could be a decade or more. So you don't want your wealth to be stagnant or on the massive decline for a decade. It's just so counterproductive to where you want to go in your future. So having uncorrelated assets will completely hedge against that and keep you safe. Now back to what uncorrelated assets are. To list a few, you have real estate, commodities, currencies, and alternative investments like hedge funds. But with the progression of technology and where we're headed, alternative assets are broadening with the expansion of technology, meaning we are finding more and more ways to find uncorrelated assets to perform for us, leveraging the power of technology. For instance, algorithmic trading, which has been really heavily used in a lot of investment banking and hedge funds, but now it's becoming a bit more retail where people are actually able to leverage the power of algorithmic softwares that trade for them, which means most of the time, depending on which ones you're looking at, you found yourself in uncorrelated assets because the way that they have the softwares is often playing both sides of the field, both long and short, and it's typically high frequency, so you're never subject to holding an asset long enough to experience all of its volatility, meaning if you buy something, you hope that it goes to the moon so you can become rich with it going to the moon, or if you shorted something, you hope that it plummets to the floor and you make a bunch of money. But with these things, it's in and out, and it's just capitalizing on micro movements with X amount of leverage on there, so it doesn't matter how long you're holding the asset, it just matters that you capture that movement, which requires zero of your effort. So there's no such thing as passive income, but there are things that are very close to it, and what I found utilizing technology to trade for me is it's probably the most passive thing that I've ever experienced. And you might be thinking, well, what about Bitcoin and what about crypto? Yes, crypto is an alternative asset. Unfortunately, if we look at the data, now when you look at the S&P 500, which is the top 500 companies, and you plop that chart right next to the chart of Bitcoin's performance, you will notice they are pretty much in tandem. When Bitcoin first was emerged into the world, there was this heavy use case of this is going to be an uncorrelated asset to market volatility and the economy, and it's going to be a safe haven. Unfortunately, it's been pretty much in 100% tandem with traditional equities. So I cannot confidently say Bitcoin falls into that basket of uncorrelated assets. But what I can say is there are some alts, and unfortunately not enough, plus it's extremely hard to find the alts that will move uncorrelated. And even though if they do move uncorrelated, they typically will revert back to a means. So the performance of, let's say, an altcoin going on a bull run while everything is in a recession or a downtrend is very short-lived. So I don't find it quite feasible to dabble in the crypto market as an uncorrelated asset. While there are gains to be made, it is very hard to find which ones will actually be that performer because, again, there's thousands of projects, and Bitcoin being the main one that drives majority of the flows of the cryptocurrency market, it's just not feasible. Plus, it's going to take tons of time and effort to try and find which ones are appropriate for you. One thing that I'm doing, like I said earlier, is leveraging technology to perform as my uncorrelated asset. Whether you have real estate, and if you compare the real estate to how this algorithmic performs, then you're going to see the technology is far outpacing the performance of real estate. And then again, if you compare it to commodities, and I have tons of other videos comparing it, it's performing far better than any commodity that I found. And again, I can go across the board of this algorithm's performance compared with other uncorrelated asset performances. 9 out of 10 times the algo typically does far better, and by like a large margin, not just like a little bit. So if you're looking for something that could potentially offset the risk in your portfolio, and you're interested in licensing a software that could trade for you and let you experience what uncorrelated gains feel like, then the link is down in the comments and in the description below. And if you enjoyed this video, please leave a like, subscribe, and or thumbs up. But either way, like always, my friends, peace.